As expected, the Bank of Canada this morning had their announcement here on April 10th, 2024, and they kept the rate exactly the same with a few clues and a few hints as to when the interest rate might start to drop. So this morning, the Bank of Canada's rate announcement left the interest rate exactly the same at 5%. That leaves variable rate mortgages at about 6.3% with most lenders, and fixed mortgage rates are still sitting around the 5% mark, depending on which term and which lender you're working with. The bank noted in today's announcement that they are continuing with their policy of quantitative tightening. That's the opposite of what the bank did during the COVID pandemic, when it was essentially printing money and putting a lot of liquidity into the market by issuing bonds at very low interest rates. That allowed mortgage rates to get to all-time low records of around 1.5% with many of our lenders. So the opposite's now happening. Instead of selling off bonds, they are not renewing bonds that are coming up for maturity. So they're getting rid of things on their balance sheet, which is making it so that the market has to do all of the pricing. And that's a big part of the reason why fixed mortgage rates have come up over the last couple of years. However, with economic data, that also impacts the fixed rate pricing. And we do see some impact from the inflation reports and the jobs reports and everything else that impacts both fixed and variable rate mortgage pricing. So the Bank of Canada did point out that CPI inflation in February did drop to 2.8%, which was amazing, and we're super happy to see that. We have not yet received the March 2024 data. But they did note that the easing of price pressures was becoming more broad-based than it previously had been. So they do take a look at something called core, CPI core inflation. And some of the items in that have been running above 3% inflation, even as the overall inflation rate has been trending down. But some of those items that they were concerned about are now starting to nudge lower at around 3% in February, which previously had been about 0.5% higher. So that's also good things. And when you look at the last 3 months revolving over the last few months, there is good indication that those are going to continue to trend downward. The bank expects that the inflation will hit its target of 2% by early in 2025. So we are on track, and that's a good thing. And so that does help support our previous estimates that we would see the Bank of Canada start to lower its rate as early as next announcement, which will be on the 5th of June. As far as fixed interest rate pricing is concerned, you can see here over the last 6 months, there's been some dips in the pricing, but then some upward pressure as well. We are seeing 5-year fixed interest rates under 5% again after they increased to almost 6% later last year. And so what we're seeing now is with the U.S. strong inflation, their numbers are coming in a little bit higher right now. We're seeing the U.S. 10-year fixed bond rates, that's the green line on your screen, those are starting to trend back up. And Canada's 5-year bond rate very closely mirrors its movement. While the rates aren't exactly the same, when one goes up, the other goes up, and when one goes down, the other tends to go down. And Canada being so much smaller than the United States, we're not the ones causing the other to move. So Canada's rate is heavily impacted by what goes on in the United States. Their inflation rate, this morning they released the data. It came in high at 3.5%. Meanwhile, Canada's most recent reading was at 2.8 back in February. Now, in February, the United States rate was also higher than ours. But with that upward pressure, what that means is that the United States, the US Fed, may hold off a little bit longer before it starts to decrease its interest rate. And that has an impact here in Canada, because if the Bank of Canada lowers its interest rate, it's going to have a negative impact on the strength of our dollar. And while that's great for Alberta when we're exporting oil in US dollars, it's not so great when we're importing everything else, including our food, because that is sold and traded in US dollars. And so it makes everything a little bit more expensive, and we'll have some upward inflationary pressures. So the Bank of Canada can start lowering its interest rate before the US Fed does, but it can't do too much if the US Fed isn't also doing something similar. So where does that leave us? Well, Nobody expected an interest rate drop today. There's maybe a sliver of hope among a few, but not really. We're still pretty strong on expecting it to be in June. In the last few days, the bond market has been pricing in an 88% chance of a June 5th rate drop by the Bank of Canada. And even if it doesn't happen then, we should definitely see it by July 24th. So you can expect those to start coming down. Hopefully, we'll start also seeing the fixed rates continue their downward trend. And you know what? That's going to cause upward pressure on home prices, because as the mortgage rates come down, we generally see upward pressure on home prices. Calgary is seeing a lot of upward pressure already. Edmonton's doing the same. And so as rates come down, be prepared for home prices to go up. If you have a mortgage renewal later in the year, that's awesome, because it's going to start to trend downward and it won't be as expensive as it was for people who are renewing last fall. So that's what I've got for you today. Thank you for tuning in. Thank you for listening. Please click on like to the video so other people can see it as well. Please subscribe to the page, maybe hit that bell so that you get notified as I have more updates here in the future. Thanks so much, everybody. My team and I are looking forward to helping you. Talk soon.